Okay, so the last time I shot a video like this, the Dow was just reaching 50,000. And today, here we are, the Dow is just reaching 50,000. So we had a 9% drawdown, but we've clawed our way back for the moment. But what's different this time around? So for one thing, the market had been trading at 23 times forward earnings last time. Today, guess what? We're only at 21 times earnings. That tells us that the market is about 8 or 9% cheaper than it was last time. And that price, that P number, is the same place it was at. It's that earnings number that's climbing. Earnings expectations continue to grow. Not only are the expectations on the rise, but even during the current season we're in, earnings season that we're in, companies are outpacing their estimates. So as the time I'm recording this, about three-quarters of companies in the S&P have announced 84% of them have beaten their first quarter estimates with an average positive surprise of 10 to 12%. So earnings growth is on its strongest pace, believe it or not, since 2021. That was when we were coming out of COVID. Corporate fundamentals are really strong. Okay, so what about inflation? What about the economy? How about the Fed? The last inflation reading was an uptick, moving in the wrong direction up to 3.3% on the headline number there. A lot of that was fueled by energy prices. Certainly the Iran conflict is in play, and hopefully that component of it is temporary. It looks like the Fed's going to be patient with rate cutting. At least that's what the market is telling us. Based on bond prices, there are no further rate cuts expected in 2026. Kevin Warsh about to enter his term as the new chair. Remember, the chair only gets one vote out of 12 on the board. He has influence over the narrative and the conversation and kind of running these meetings. But he doesn't have any unilateral power all by himself. So Jerome Powell, by the way, is sticking around. He's going to be on the board. He gets one of those 12 votes too, and likely will have a strong voice. Let's touch on jobs real quick. So the March jobs report was awesome, 178,000 new jobs. It should be much lower in April, and that number might be out any day if it isn't already by the time this video goes out. But given the rise of productivity, the productivity metric, the need for new jobs is not as critical to the growth of the economy as it used to be. So still an important number, but hey, unemployment in the last report was down to 4.3%. We're not worried about the labor market at the moment. What does have our attention right now is concentration risk. So if you've met with us recently, you probably already know that in the S&P 500 right now, the top 10 stocks make up almost 40% of the index. That means the other 490 stocks are splitting the remaining 60% weight. And that's about as high as the concentration has ever been. Though these top 10 names are outstanding companies, they're also the ones driving that valuation metric higher. One of the themes that we have today that we'll always have is growth at a reasonable cost. So it's not just growth at all costs. While the S&P 500 is trading at that 21 times earnings today, our core equity model is trading in the high 17s, we're proud to say. So we're doing that because we have weight to international emerging markets and certainly value-oriented companies. And here's why we're doing that. So let's take a look at this chart. Along the bottom, we're seeing the concentration levels of those top 10 stocks. These are historic rolling 5-year periods. On the left-hand side, going up and down, those are the odds that the bottom 490 stocks will outperform those top 10. So this tells us that when concentration reaches high levels, market leadership often broadens out over time, specifically when the top 10 make up only 23.4% or more. The bottom 490 have outperformed the top 10 for the following 5 years, 91% of the time. So we are positioned accordingly just for that. But overall, hey, we're positive on the economy. Corporate fundamentals are certainly strong. We don't want to get complacent and just lean into passive investing and these big growth names that have been the dominant story for the last decade. we're positioned to capitalize on a more broad level of participation. But as always, if you have any questions or thoughts about your portfolio or the market or anything at all that's going on, please don't hesitate to reach out. Thanks for watching.